Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral, Dadia. We have with us Dr. Pawan Singh, MD at PTC India Financial Services, joining us on the show. Welcome to the show, Pawan. My first question coming to you over here is, all of us have seen the kind of impact that COVID-19 has had in terms of sectors across, economies across. Now, when we see the fourth quarter numbers as well, yes, there is an impact that we are ascertaining over there, but overall, is it mainly COVID that has led to the decline in terms of profitability? Because the revenues have almost remained pretty much flat.
Yeah, see what happened in our case, we are not anyway affected by COVID-19. So we have been largely insulated by that because our business model is such that most of our borrowers are into either road, HAM projects and renewable energy. So even power offtake went down because at the peak of lockdown, power offtake had gone down by 40%. But renewable energy constitutes only 10% of the total power offtake. So, and it's a must run. So they continue to buy power. And of course, discoms, some of them have been making delay in payments. So that situation continued to be the way it was before pre-COVID, and post-COVID didn't make so much of a difference. And road annuity projects, government came with intervention, so support was available. So we hardly had any, stress on our portfolio because of the COVID impact. Even the moratorium, which was liberally given by us because our liquidity position was very good, and we wanted borrowers to come and take moratorium. We wanted to support them, but despite that, only 2% of the borrowers came, and some of them, paid back early. Only all negligible portion, which is state discom, because state discoms were not having collection, as many of them have manual collections systems. They're gradually moving to e-payments, but they still have a very, very large portion of manual collection. So they had some cash flow issues. So that was 2% of whatever moratorium was taken. So we were largely insulated. For us, it was quite, things were quite all right. In fact, in one way, I would say it was blessing in disguise because you were put to a stress test and you came out. So that's one. Now my earning has been flat because I have downsized my loan book, not because of anything else. There's been a marginal increase in the earning, but despite the loan book coming down. So my loan book reduced by close to 1,800 crores, but still my earning was a little better than what it was last year. And that is because of a lot of stress assets which were there in my portfolio, we were able to liquidate. And also partially because of, because we do, as I mentioned, do lend in the renewable space. And there are mergers, acquisitions happening. And because there was this merger of Greenco with Orange Group, and we have a single exposure limit of RBI as to 40% of my net worth I can only lend to a single individual. So with this merger, the exposure was getting crossed. So they had to do some mandatory payment back to us, loan they had to, before the tenure of the loan was over, so they had to do prepayment. So these two reasons led to my book size getting down, but still my revenue were all right. In fact, on the operating parameters, we have improved. And our liquidity position was quite good. Even, and then thanks to various measures which were taken by the government subsequently, now the impact of that again has started coming to us, because always there is a translation gap between the policy and, as we say, cup and lip. So policy. So now that action is walking the talk is happening. So that liquidity again is, so we are, liquidity used to be a big challenge for NBFC post IL&FS crisis, September 2018. That now we are 100% out of it. So from now onwards, we'll be able to do, because we have a good pipeline, with this kind of liquidity and having resolved our stress assets, we'll be able to consolidate and move forward with our numbers. So our numbers should look much better, because having cleaned up, what is very important is that my profitability was, if you look at my profitability, I did provisioning of close to almost 190 crores this year, against 70 crores last year. This 190 crore has almost cleaned up. So my unprovided loan amount, whatever I have, my balance sheet just come down substantially, is what is mostly realizable. So my worries are quite over, because I had this, because about 1.5 years back when I took over, I had close to about 2,200 crore of stress book, out of which only 500 crore was provided, and 1,700 crore was unprovided. Today, I only have unprovided stress in my loan book. In my book is close to about little over 350 crores. So, and that also I said it's all realizable. They are all the residual value which is available. So all is going to come back to me. So that gives me a lot of assurance and confidence to move ahead in the business. And my credit cost, which was really impacting my P&L, is not going to be there.
Right. So with this, one thing is, you mentioned about the asset quality as well, which has improved substantially with the kind of resolution that we've seen in terms of the stressed assets. If you have to look at FY21, are we expecting similar kind of performance, or do you think there is a possibility that there could be a spike in terms of NPAs, at least in the first half of the year, taking the given situation of the economy?
No, see, as when I started explaining the whole thing, I said that our loan book is, what we did, two things, last 1.5 years, our strategy has been, one thing is very clear. COVID has given us a very great lesson. So they've said what is good for, environment is good for economy. So what will be good for, so something which is not good for environment will not be good for economy. So that we had a thermal portfolio close to 60% about 4 years back, down to 30%. Now my running thermal portfolio is only 5%.
Correct.
So what we are trying to do is we are trying to decarbonize our balance sheet. Carbon neutral. Not carbon, we are carbon positive because 60% is renewables. Far more carbon positive company than many companies are. And as I said, renewable is the thrust of the government. So they have to be mandatorily bought. So many states still have to meet the RPO obligation, renewable purchase obligation. They have to meet that. So offtake is not an issue for that, and they get priority status in terms of operation. They also get priority status in terms of payment. So for us, if you have to rank, because you can't every size doesn't fit all. So same size doesn't fit all. So you can't have same thing happening on the various segments of economy. Now tourism, different impact. Hotel, different impact. Aviation, different impact. Pharma, different impact. Telecommunication, different impact. So similarly, we are, if you have to rank ourselves in the resilience, in terms of resilience post-COVID, we are among the most resilient, we'll rank among the most resilient sector because of my loan book, which I have, that is renewable and road annuity projects and transmission lines. So I'll continue to get my payment because that's the priority of the government. I've been getting that and I'll continue to get that. So we are not going to be affected. So the way I look at it is, for us, the previous year was the year of consolidation. It was not the year of expansion. I told, cleaning up of balance sheet, challenging liquidity position, systems and processes in place, work on my operating margins. So this having put all this in place and having a huge liability support now in terms of resource, long-term and short-term. We are very well, and pipeline which is available. We are very well positioned, to take forward. And we are infrastructure finance company, and government has announced that infrastructure, the only way to revive economy will be through infrastructure spending, because you can't revive economy unless you do infrastructure spending. Now, we stuck to our ground because a lot of people, last 1 year when NBFC crisis happened, people felt that, the days of big ticket lending is over. And ICICI Bank, their project division, downsized themselves. IDFC converted themselves into a bank and said, no more finance. ILFS wiped out. They're also in infrastructure finance. Today, infrastructure said that we'll not be doing infrastructure finance, end of us. But we stuck to our guns. We'll do infrastructure selectively, what we know, and where, there has been learning for us that this is an area we'll not touch infrastructure. This is learning for us that this is an area which has proved to be very good. And that is the area where we have developed our ability and competence and learning experience over a period of time. So we'll continue to be there. So with the thrust in the government, and now that we have this competitive advantage because many of the players not being there, so we feel that we can play much bigger role in coming times. And my own vision is that we should be playing a role not through a incremental support, but we should be going for a very, very strategic quantum growth as far as our business is concerned. So we are hoping for a very good both in terms of business and in terms of top bottom asset base, all three, if I say 360-degree parameter, all 360-degree parameter, we would be able to do much more than incremental. I'm not talking about incremental, so I'm again repeating the point. One size doesn't fit all. So what is good for goose may not be good for gander. So as we say, so for us, it is going to be very good opportunity, and that we have consolidated, that base we have created, opportunity we have, support resources we have. So we can really capitalize on these things are, and then we are trying to be sustainable finance company. And I feel that this is going to be the order of the day because sustainability is going to be premium. So our focus will not only contribute to triple bottom line, but also, when I say triple bottom line, also includes environment. So in a big way, contributing to the development of environment is what we would be focusing while we make a little bit of money for our shareholders.
Right. But with this, on the back of the moratorium on the loan repayments by the RBI, last number what I saw was that PFC, the company was impacted to the tune of around 260 crores, where 40% of the borrowers availed moratorium. Are you still seeing an increase on this front?
See, there were moratorium 1 and moratorium 2. So my total book size is a little over 11,000 crores now. So I said 200 crore, close to 200 crore is the moratorium value. That is moratorium 1. In moratorium 2, we have got a request of another 300 crores. So if I combine both 200 and 300, so it makes 500 crores. Now, for us, what we have done is that, instead of playing with the moratorium, what we have done is that we have taken the entire amount and put it as the last installment of the loan payment. So, presuming a loan which had to be paid in 20 installments, now the moratorium portion, which includes both interest and principal, goes to the 21st installment. So, by doing so, I'm not putting a burden on my borrower. That is one. Second is, at the same time, since I have no problem of liquidity, because I have close to about 2,500 crore of liquidity available for me. So might as well suits me, because my existing borrowers are taking moratorium and changing the repayment schedule. So I expand my loan book by that much amount, 500 crores. But these are good projects. Why I should not be doing it?
Correct. Yeah, what you're saying is absolutely right. So with all of this, as we are seeing an improvement that's coming in across parameters in FY21, Pawan, by how much are you expecting the yields, spreads, as well as the net interest margins to improve?
See, yields have already gone up last 18 months. If you look at my yields, they have gone up by almost close to 130 to 140 bips.
Basis points, correct.
So what is going to happen is, my yields would be something slightly better than that, marginally better than that. But effective yields will go up because whatever little stress is available because my 90% of whatever remaining stress is there in the balance sheet will go away this year. So what happens is that stress-bearing assets don't give any yield. So whatever yield I'm getting, they kind of pull it down. So that pulling down factor will not be there. So One is through efficiency improvement, 10 to 15 bips, and through declining my stress asset, another 10 to 15 bips improvement I expect to have in my yields. But more important than yield is my spread, because the impact of borrowing cost has started to come now, because whatever borrowings now, because see what happened, my 90% of borrowing is bank borrowing. And there is a translation issue, because banks announce interest rate cut and RBI interest rate cut and the bank's interest rate cut, and then getting the impact in the borrower's balance sheet. So we get repriced on a reference rate. So all of them are getting repriced. During the year, I'll get repriced. So I expect at least, in my, if you look at my closing cost, which I have for the entire year, I expect at least 50 to 60 basis reduction in my borrowing cost. So 20% on the yield effectively, both stress and efficiency improvement, and 50 to 60 bips improvement in my borrowing cost. So because of that, my spread should jump to about 75 bips. That is what my expectation is.
Right. And right now, as you already mentioned, that the focus with regards to thermal has already gone down. Now, majority of the product portfolio comes in from the renewable energy segment, and then the remaining 20% is infrastructure, is what we are looking at. Are we expecting a further change that could be coming in with regards to the product mix from here on?
Yeah, it's already started, because see, we did sewage treatment plant, and we have recently, we had sanctioned 2 months back, but now my board has allowed disbursement to happen. So we are doing disbursement in waste, waste management. We are doing disbursement in water distribution, and we are doing also electrical vehicle. And then we are trying to move to additionality in renewable energy, where you have storage versus wind and solar. So now, like, many of the developers are working on 2024, because normally renewable was for peak power and not round the clock. So round the clock power, where combination of storage, battery or pump storage with solar and wind combination. So these are the new products we are looking at very closely. I mean, we are at a very advanced stage of sanctioning certain loads. So as I said, that we are moving toward an additionality in renewable, additionality in sustainability. And additionality is the one I'm talking about, is battery storage, electrical vehicle, your e-charging, your waste management, your water treatment, sewage treatment and water management, and also your around-the-clock power through renewable, through pump storage and wind solar combined.
Right.
Of course, we will continue to do third-party PPA to counter. We are one of the few organizations who have been doing that. We'll continue to do that.
Right. And overall, on the cash flow perspective as well, as you mentioned, the company is really comfortable right now. Now, you do have an undrawn credit line of almost around 1,400 odd crores. The high quality liquid assets are also in that range of around 250 odd crores. And a fresh credit line of almost 1,000 odd crores is under consideration with various lenders. So by when do we see utilization of 1,000 odd crores that could come in?
So, see what happens, 600 crore has already happened. So by the time I'm to you, so as on date, I have 600 approval already in place. Balance, not 600, but balance about close to 700 crores is almost at the stage of approval. So next, maybe 3 days, 4 days, max a week, approval should be available with us. So 600 you can add to 1,400 to 6 plus 600, 2,000 crore I already have. And HQLA of about close to 270 I already have. So that's why I said 2,200 crore of backup is available. And along with that, I mentioned about another 5 plus 200, 700 on annual anytime. We also have, that will come a little later, not now, maybe August, September. In principle approval from IFC along with JICA and Australian institution for $75 million
Mm.
loan. Another $125 million loan from US Development Institution, OPIC. That these two should happen. They are at a very advanced stage. They have given in principle advanced stage of due diligence. So we expect somewhere middle of August or beginning of September, these amounts also to come to our.
Right. And with this, Pawan, my other question coming to you is with regards to where the finance projects go. When we see almost 50% of the loan book is, commissioned renewable projects, and they already have a run status to it. Now, the projects which are under commissioning or where, project activities have been halted, what's the step that you would be taking? Do you see any risk on that front?
No, see, two things. One is 60% of my projects are now commissioned. Now, if you look at balance 40%, out of this balance 40%, 21, 22% will never be commissioned because they are not for projects. They are for, loan to distribution companies for meeting their cash requirements. So roughly if you take out that, so 80% is, you can take it as completed. So it leaves only 20%.
Okay.
Now what we have done is that, see, our experience has been, and then of course, thermal is only 5%. That is also completed, and another 5% which is not completed, which I said non-running thermal, which is of course at various stages of liquidation. So that takes care of my 85% of the portfolio. 15% is under what you can say is under construction type of portfolio. That, what we have tried to do is that our experience has been that we have been trying to do projects with as less gestation period as possible, because renewable normally takes 6 to 9 months to get completed. So all of them are very, very low gestation period. So large, and of course, HAM projects, that's where of course, 24 months to 30 months time is there. So maybe a very small portion, 3 to 4% would require about 2 years of commissioning time. Balance would be either 6 to 9 months. So that is where we have moved about. And even that 5% that what I have, where it will take 24 to 30 months, we ensure land, etc. is acquired, right of way, clearances, everything, because they are HAM projects. So HAM projects, all clearances are available upfront. So we are avoiding to do the mistake, which lenders did in past. And we were also part of it, because my stress asset is largely on account of that, because projects taking 5 years, 6 years to commission hydro and thermal, cost overruns happening, and our inability to participate on the cost overrun, and promoters not able to bring equity. These have been the lessons learned. We will not repeat that mistake again. So we don't do that now.
Right. And overall, with regards to where NCLT related cases are concerned, we know that, you've already made a provisioning for that, but how much recovery are you expecting or you are providing for in FY21?
So see, I have unprovided stress asset of 375 crores approximately, and out of which roughly 150 crore I have one-time resolution offer already. So maybe in a month's time, our board in principle also is in consent to give the approval. Only we have to take a formal approval. So that goes out. So that leaves me with 230. Out of this 230, one of the assets already, 11, 12 bidders have come. And here also the amount is roughly about, residual amount is close to about 115 crores. And since the debt equity ratio is 50-50, so cost per megawatt is 3 crore, up and running plant, and offers are close to 3 crore. So we hope to recover entire 150 and provide. So that takes care of this plus this, about 370 crore of, so leaves with 100 crore of, amount which is at various stages of resolution with NCLT. And there, this out of this 100 crore, whatever is there at various stages, this also, because they have already been adequately provided for. So out of this 100 crore, we feel that a very large chunk of amount will come back to us. In some of the cases we have already provided for, but we hope 100% provisioning we have done, but small amount is likely to come back to us. So we feel that net we will be neutral, 10, 15 crore plus, 10 crore, 15 crore minus. This is what we are, expecting as the resolutions go forward. So this is where we come from. Right. One of our assets, of course, is not in NPA, and there probably some stress has happened because of the promoter becoming, not being able to put money. So there, probably that will have to, take a little bit of credit cost there, some small amount, in addition to what I have unprovided NPA mentioned. That is all about that. So, that is why I go back to my original remark. The credit cost, which was the largest portion of my credit cost outside my interest payment, is no longer an issue for me.
Correct.
And that is why we feel far more assured than what we felt about few months back or a year back or 1.5 years back or 2 years back.
Right. And very lastly, Pawan, do you think there would be a need, just to get off the risk to make a provision on the back of COVID impact? Do you think there is a need to do that, or are we comfortable on those levels?
See, already my provisioning coverage ratio is, with provisioning and, we have created certain reserves out of provisioning and overall P&L provisioning also. So combined together, we have done, and these are all residual value of assets.
Correct.
These are not assets which are all, we have reached a stage where they are, reaching some kind of a solution. So all close to 55% kind of provisioning is available, both in terms of, appropriation to reserve and provision to profit and loss account. So going forward, if required, we'll do provisioning, but we think as of now, we have done adequate provisioning, keeping into consideration the kind of realization which is likely to happen. And as I said, in our case, the COVID, requirement the restructuring has happened in a very different form, where we have kind of passed on the interest and payment to a final installment. And I said that since most of them are renewable projects up and running, backed by PPA, must run priority payment. So I think we are comfortable, whatever we have done.
Right. So, it looks like it's going to be a good year as well for PTC with the kind of improvements that we've seen in the last 15 to 18 months. So good luck for the same, Pawan. We will come back to you as well once the impact of COVID overall for the economy comes down as well, and see how the improvements were happening. But congratulations once again for the numbers, and hope to see you soon. Stay safe.
Yeah, thank you. Let me come back to you and vindicate what we have promised here.
Yeah, sure. Perfect. Thank you.
Thank you.